I am Bharati, your accountancy teacher. Today we are going to see about chapter 9, ratio analysis. Under the topic Introduction, meaning of accounting ratio, liquidity ratio, long-term solvency ratio, profitability ratio. The above topics will be discussed in this class. Now we can see the topic meaning of accounting ratio. Ratio is a mathematical expressions of relationship between two related or interdependent items. When ratios are calculated on the basis of accounting information, they are called accounting ratio. Then second one, we can say the second topic, meaning of ratio analysis. Ratio analysis is a tool which involves analyzing the financial statements by calculating various ratios. Definition of ratio analysis. According to Miles, ratio analysis is a study of relationship among various financial factors in a business. And what are the functional classification? Liquidity ratio, long-term solvency ratio, then profitability ratio. The first one, liquidity ratio. So under the liquidity ratio, current ratio and quick ratio. Then long-term solvency ratio, debt equity ratio, proprietary ratio, then capital gearing ratio. Then finally profitability ratio. Under the profitability ratio, gross profit ratio, operating cost ratio, operating profit ratio, net profit ratio, then return on investment. So these are all the profitability ratios. Now moving on to computation of ratios. The first one is liquidity ratio. Liquidity means capability of being converted into cash with ease. Liquidity ratios help to assess ability of a business concern to meet the short-term financial obligations. Liquidity ratios include current ratio, then quick ratio. What in by current ratio? Current ratio gives the proportion of current assets to current liabilities of a business concern. It is known as current ratio. The following ratios are calculated. What are the formula of current ratio? Current assets divided by current liabilities. So items of current assets and current liabilities. Current assets means current in investment, inventories, trade receivable, cash and cash equivalents, short-term loans and advances given. Then other current assets, that is expenses accrued in income etc. அதாவது expenses, that is other current assets, அதாவது the ratio பார்த்தீங்கன்னா expenses accrued income etc. So these are all the including current assets. Then current liabilities, short term borrowings, loans, trade payables, that is a bills payable, in sundry creditors. Other current liabilities, expenses payable, income received in advance etc. Then short term provisions. So this is all the including current liabilities. Quick ratio, it gives the proportion of quick assets to current liabilities. It shows whether the business concern is in a position to pay its current liabilities when they become due out of its quick assets. It is also known as liquidity ratio, or another name is acid test ratio. Then what are the formula of quick ratio? Quick ratio formula, quick assets divided by current liabilities. So quick assets means current assets minus inventories. Inventories means stock minus prepaid expenses. So long-term solvency ratio, it means the firm's ability to meet its liabilities in long term. It helps to determine the ability of the business to repay its debts in long run. So types of long-term solvency ratio. Under the long-term solvency ratio, first one is debt equity ratio, then second one proprietary ratio, then third one capital gearing ratio. First, debt equity ratio. It is calculated to assess long-term solvency positions of a business concern. It expresses the relationship between long-term debt, for example, shareholders funds, debt equity ratio formula, long-term debt divided by shareholders fund. The long-term debits includes debentures, bonds, long-term loan, or for example other long-term borrowing. Shareholders funds means equity share capital plus preference share capital plus resource and surplus. Then next one ratio, proprietary ratio. Long-term solvency is one of the ratio. So another one of the ratio is proprietary ratio. The first one is debt equity ratio. The second one proprietary ratio. Proprietary ratio means it gives the proportion of shareholders funds to total assets. It shows the extent to which the total assets have been financed by the shareholders funds. So proprietary ratio minus, so what are the proprietary ratio formula? Proprietary ratio equal to shareholders funds divided by total assets. Shareholders funds means equity share capital plus preference share capital plus resource and surplus. Then another one ratio, capital gearing ratio. It is the proportion of fixed income bearing funds to equity shareholders funds. It includes fixed interest and fixed dividend bearing funds. So capital gearing ratio formula, funds bearing fixed interest or fixed dividend divided by equity shareholders funds. First, funds bearing fixed interest or fixed dividend means preference shares capital minus debentures minus bonds. So long term borrowing carrying fixed interest means equity shareholders fund. Equity, what are the formula of equity shareholders fund? Equity shareholders funds means equity share capital plus resource and surplus. Then profitability ratio. It helps to assess the profitability of the business. That is these ratios also help to analyze the earning capacity of the business in terms of utilizations of resources employed in the business. So the types of profitability ratio: gross profit ratio, operating ratio, operating cost ratio, operating profit ratio, the net profit ratio, return on investment. The first one, gross profit ratio. It is the proportion of gross profit to net revenue from operations. It is the margin of profit available out of the revenue from the operation. That what are the formula of gross profit ratio? Gross profit divided by revenue from operations into 100. So gross profit means revenue from operations minus cost of revenue from operations. Then another one ratio, operating cost ratio. It is the proportion of operating cost to revenue from the operation. So this ratio is the test of the operational efficiency of the business. Then operating ratio, operating cost ratio. What are the formula of operating cost ratio? Operating cost divided by revenue from operations into 100. Operating cost means cost of revenue from operation plus operating expenses. So operating cost minus cost of revenue from operations plus operating expenses. Operating expenses means employee benefit expenses plus depreciation plus other expenses related to office and administration expenses. So selling expenses and distribution expenses. So these are all the operating expenses. Then operating profit ratio. Operating profit ratio is used to find the operational efficiency of the business. Then operating profit ratio formula, operating profit divided by revenue from the operations into 100, operating profit ratio minus 100 minus operating cost ratio. Then operating profit means revenue from operations, operating cost. The net profit ratio. Net profit ratio is the percentage of profit on the revenue from operation. Net profit ratio equal to net profit after tax divided by revenue from operation into 100. So net profit after tax minus gross profit plus indirect income minus indirect expenses minus tax, or net profit after tax minus revenue from operations minus cost of revenue from operations minus operating expenses minus non-operating expenses plus non-operating income tax. Next, return on investment. Return on investment shows the proportion of net profit before interest and tax to capital employed. So what are the formula of return on investment? Net profit before interest and tax divided by capital employed into 100. So capital employed means shareholders funds plus non-current liabilities. So students, now we can see the problem. Solve to exercise number 1 to 7. So see the book. Question number 1. I will read the question. Liquidity ratio. Calculate the current ratio from the following information. So current investment, inventories means stock in trade. Trade debtors, bills receivable, cash and cash equivalents. Then fixed assets, trade creditors, bills payable, expenses payable, the non-current liabilities. So all the current items is given. So with the help of the informations, find out the current ratio. What are the formula of current ratio? Current assets divided by current liabilities. First, we know the meaning of current ratio. Current ratio means current ratio gives the proportion of current assets to current liabilities of a business concern. It is computed by dividing current assets by current liabilities. Current ratio indicates the ability of one entity to meet its current liabilities as and when they are due for payment. It is calculated as follows. Current ratio equal to current assets divided by current liabilities. Current assets means those assets that are either in the form of cash or cash equivalent or can be converted into cash or cash equivalent in a short time, that is within a year or within the period of operating cycle. Then current assets includes current investment, inventories, that is stock, trade receivable, that is a bills receivable and sundry debtors less provision for doubtful debts. Cash and cash equivalent means cash in hand, cash at bank, etc. Then short term loans and advance given. Then other current assets means prepaid expenses, accrued income, etc. Then what will be current liabilities? Current liabilities are those liabilities which are repayable in short time, that is within a year or within the period of one operating cycle. Then current liabilities include short term borrowings, trade payable. Trade payable means bills payable and sundry creditors. Then other current liabilities means expenses payable, income received in advance, etc. Then short term provisions. So first, what are the formula of current ratio? Current assets divided by current liabilities. In this question, current assets means current investment plus inventories plus bills receivable plus trade debtors plus cash and cash equivalent. Current investment rupees 40,000 plus inventories rupees 2 lakh. Bills receivable rupees 1,20,000, trade debtors rupees 80,000 plus cash and cash equivalent rupees 10,000. Totally rupees 4,50,000. In this value is known as current assets. Then we can go to find out the next step, current liabilities. Current liabilities means trade creditors plus bills payable plus expenses payable. Trade creditors rupees 80,000 plus bills payable rupees 50,000 plus expenses payable rupees 20,000. Totally we get rupees 1,50,000. So already find out the current assets and current liabilities value with the help of the formula. Substitute the value, find out the current ratio. So current assets 4,50,000 divided by current liabilities 1,50,000. So we have calculate the current assets divided by current liability, we get 3 by 1. So 3 is to 1. 3 is to 1 is the current ratio. Then question number 2. Calculate quick ratio. Total current liabilities rupees 2,40,000. Total current assets rupees 4,50,000. Inventories rupees 70,000. Prepaid expenses rupees 20,000. So quick ratio means given the proportion of quick assets to current liabilities, it indicates whether the business concern is in a position to pay its current liabilities as and when they become due. So out of its quick assets are current assets excluding inventories and prepaid expenses. It is otherwise known as liquid ratio or acid test ratio. Another name is acid test ratio. It is calculated as follows. Quick ratio equal to quick assets divided by current liabilities. Quick assets means current assets minus inventories minus prepaid expenses. Then higher the quick ratio, better is the short term financial positions of an enterprise. So what are the formula of quick ratio? Quick assets divided by current liabilities. So quick ratio, quick assets means current assets plus inventories. Inventories means stock minus prepaid expenses. Current assets rupees 4,50,000. Inventories plus 70,000. Then prepaid expenses minus prepaid expenses rupees 20,000. So we get rupees 3,60,000. In this value is known as quick assets. Then quick ratio. What are the already current liabilities values given? Current liabilities rupees 2,40,000. So what are the formula? Quick assets divided by current liabilities. Quick assets value 3,60,000 divided by current liabilities value 2,40,000. So we get 1.5 by 1. So நம்ம ரேஷியோவா கன்வெர்ட் பண்ணினா numerator is to denominator. So numerator 1.5 இருக்கு, denominator 1 இருக்கு. So that 1.5 is to 1 is the quick ratio. Then come to the question number 3. Following is the balance sheet of Lakshmi Limited as on 31st March 2019. Equity and liabilities, that is a shareholders funds value. Equity share capital 4 lakh. Non-current liabilities, then long-term borrowings 2 lakh. Current liabilities, under the current liabilities, short-term borrowing 50,000. Trade payable 3,10,000. Other current liabilities, expenses payable 15,000. Then short-term provisions 25,000. Totally 10 lakhs. Then asset side, non-current asset, fixed assets, that is a tangible assets 4 lakh. Current assets, inventories means stock 1,60,000. Trade debtors 3,20,000. Cash and cash equivalent 80,000. Other current assets, that is a prepaid expenses 40,000. So total assets 10 lakhs. So both sides will be shown in a equal value. Then current assets and liability side. So what are the question? The question is find out the current ratio, then quick ratio. What is the formula of current ratio? Current assets divided by current liabilities. Current assets means inventories plus trade debtors plus cash and cash equivalent plus other current assets, then plus prepaid expenses. Inventories rupees 1,60,000 plus trade debtors rupees 3,20,000 plus cash and cash equivalent rupees 80,000 plus prepaid expenses rupees 40,000. Totally rupees 6 lakh. Then current liabilities. Current liabilities means short term borrowings plus trade payables plus expenses payable plus short term provision. Short term borrowing rupees 50,000 plus trade payable 3,10,000. Expenses payable rupees 15,000 plus short term provision rupees 25,000. Totally rupees 4 lakh. What are the formula of current ratio? Current ratio formula, current assets divided by current liabilities. Current assets rupees 6 lakhs divided by current liabilities 4 lakhs. So 1.5 is to 1 is the current ratio. The next step can find out the quick ratio. Quick ratio formula, quick assets divided by current liabilities. Quick assets means current assets minus inventories minus prepaid expenses. Current assets rupees 6 lakh minus inventories 1 lakh 60,000 minus prepaid expenses rupees 40,000. We get rupees remaining value 4 lakhs. So this is a quick assets. So already current liabilities value is 4 lakh. So what are the formula of quick ratio? Quick assets divided by current liabilities. Quick assets value 4 lakh. Then current liabilities 4 lakh. 4 lakh divided by 4 lakh. So 1 by 1. So ratio நம்ம convert பண்ணும்போது 1:1. This is a quick ratio. Then come to the question number 4. From the following information, calculate debt equity ratio. This is a balance sheet value is given. Assets and liabilities value is given. So that you have to find out the debt equity ratio. So this is a long term solvency ratio. Another one part வந்து பார்த்தீங்கன்னா debt equity. First one long term solvency ratio. What do you mean long term solvency ratio? Long term solvency means the firm ability to meet its liabilities in the long run. Long term solvency ratio help to determine the ability of the business to repay its debts in the long run. The following ratios are normally computed for evaluating long term solvency of the business. First one is debt equity ratio, then second one proprietary ratio, third one capital gearing ratio. The first one ratio debt equity ratio. So in this question you have to find out the debt equity ratio, proprietary ratio, then capital gearing ratio. Okay, so debt equity ratio means is calculated to assess the long term solvency position of your business concern. Debt equity ratio expresses the relationship between long term debt and shareholders funds. It is computed as follows. What are the formula of debt equity ratio? Long term debt divided by shareholders fund. Long term debits means long term debits includes debentures, bonds, long term loans and other long term borrowings. Then shareholders funds, equity share capital plus preference share capital plus resource and surplus. Then first debt equity ratio formula, long term debits divided by shareholders fund. Long term debits இங்க எவ்வளவு கொடுத்திருக்காங்க பாருங்க. long term debits அப்படிங்கிறது நம்ம என்னென்ன சொன்னோம், நம்ம bonds, அதாவது debentures bond. இப்போ நம்ம ஆல்ரெடி நமக்கு நான் கிரெடிட் லைபிலிட்டிஸ்ல பாருங்க, நான் கரண்ட் லைபிலிட்டிஸ்ல லாங் டேர்ம் பாரோயிங் 6% debentures கொடுத்துருக்காங்க இல்லையா? எவ்வளோ கொடுத்துருக்காங்க நமக்கு? 3 lakhs கொடுத்துருக்காங்க பாருங்க. இப்போ நம்ம ஃபர்ஸ்ட் என்ன கண்டுபிடிக்க போறோம் அப்படின்னா, so exercise number 4. So debt equity ratio, long term debits வந்து நமக்கு debentures, long term debitsனா இங்க debentures ஓட வேல்யூ மட்டும் தான் நமக்கு கொடுத்திருக்காங்க क्वेश्चनல. So 6 lakhs. Then shareholder funds means equity share capital plus reserves and surplus. Equity share capital 6 lakh plus reserves and surplus 2 lakh. Totally shareholders funds rupees 8 lakh. So with the help of the formula find out the debt equity ratio. Therefore debt equity ratio equal to long term debits divided by shareholders funds. Long term debit 6 lakh divided by shareholder funds 8 lakh. So 0.75 divided by 1 நம்ம ரேஷியோவை கன்வெர்ட் பண்ணினா 0.75 is to 1, அதாவது numerator is to denominator. This is a debt equity ratio. So next sum, question number 5, calculation of proprietary ratio. So what in by proprietary ratio? What in by proprietary ratio? Proprietary ratio gives the proportion of shareholders funds to total assets. Proprietary ratio shows the extent to which the total assets have been financed by the shareholder funds. It is calculated as follows. What are the formula of proprietary ratio? Shareholders fund divided by total assets. So higher the proprietary ratio, greater is the satisfaction for the lenders and creditors, as the firm is less dependent on external sources of finance. It is known as the proprietary ratio. So what are the formula of proprietary ratio? Shareholders funds divided by total tangible assets. Shareholder funds means equity share capital plus preference share capital plus resource and surplus. So equity share capital rupees 2,50,000 plus preference share rupees 1,50,000 plus resource and surplus rupees 50,000. Total shareholder funds rupees 4,50,000. Then total tangible assets means fixed assets plus non-current investment plus cash and cash equivalents. So fixed assets rupees 4,60,000 plus non-current investment rupees 1 lakh plus cash and cash equivalent 40,000. So total tangible assets value rupees 6 lakh. What are the formula of proprietary ratio? Shareholders fund divided by total tangible assets. Shareholder funds amount rupees 4,50,000 divided by total tangible assets value 6 lakh. So நம்ம calculate பண்ணிங்கன்னா 0.75 divided by 1 நியூமரேட்டரில் 0.75 இருக்குது. அதாவது நமக்கு வந்து டினாமினேட்டரில் வந்து ஹையஸ்ட் வேல்யூ, நியூமரேட்டரில் லோயஸ்ட் வேல்யூ இருக்குது. அப்போ நம்ம என்ன பண்ண முடியாதுன்னா டிவைட் பண்ண முடியாது. அப்போ நம்ம 0 வச்சு தான் நம்ம பண்ணுறோம். அப்படி பண்ணும்போது 0.75 நியூமரேட்டர்லையும் டினாமினேட்டரில் 1 இருக்குது. அப்போ நம்ம ரேஷியோவாக கன்வெர்ட் பண்ணும்போது நியூமரேட்டர் இஸ் டு டினாமினேட்டர். நியூமரேட்டரில் 0.75 இருக்குது, டினாமினேட்டரில் 1 இருக்குது. ஸோ தட் த ரேஷியோ 0.75 is to 1. So students, come to the next question. Exercise number 6, calculation of capital gearing ratio. So from the following information, calculate capital gearing ratio. First, what is by capital gearing ratio? So capital gearing ratio is the proportion of fixed income bearing fund to equity shareholders fund. Fixed income bearing funds include fixed interest and fixed dividend bearing funds. It is calculated as follows: capital gearing ratio. Funds bearing fixed interest or fixed dividend divided by equity shareholders funds. So funds bearing fixed interest or fixed dividend means preference share capital plus debentures plus bonds plus long term borrowing carrying fixed interest. Then equity shareholder funds means equity share capital plus resource and surplus. So capital gearing ratio is a measure of long term solvency as well as capital structure. When the capital gearing ratio is greater than 1, the firm is said to be high gear. So it is known as the capital gearing ratio. The formula fund bearing fixed interest or fixed dividend. எவ்வளோ இருக்கு நமக்குங்க? So first fixed fund bearing இன்ட்ரெஸ்ட் ஆர் இஸ் டிவிடெண்டோட நமக்கு ஃபிக்ஸட் டிவிடெண்டோட வேல்யூ பார்த்திங்கன்னா என்ன ஃபார்முலா அதில் வருதுன்னு பார்த்தீங்கன்னா, அதாவது ஃபண்ட் பியரிங் ஃபிக்ஸட் இன்ட்ரெஸ்ட் ஆர் ஃபிக்ஸட் டிவிடெண்ட்டோட வேல்யூ நமக்கு என்னென்னா அதாவது 4 lakhs இருக்குது. ஆக்சுவலி என்னென்னா த டிவிடெண்ட் ப்ரிஃபரன்ஸ் ஷேர் கேபிட்டல் 1 lakhம் டிபென்ச்சர்ஸோட வேல்யூ 3 lakh இருக்குது. ஸோ டோட்டலாக நமக்கு fixed interest or fixed dividend at a value rupees 4 lakh. Then equity shareholders fund. Equity shareholder funds means equity share capital plus general reserve and general reserves and surplus. Okay. So equity share capital 4 lakh, general reserve rupees 2,50,000 plus surplus 1,50,000. Totally equity shareholders fund rupees 8 lakh. Then what are the formula of debt equity ratio? Okay, so what are the formula of capital gearing ratio? Capital gearing ratio வந்து பார்த்தீங்கன்னா funds bearing fixed interest and fixed dividend ஓட வேல்யூ வந்து நமக்கு 4 lakh இருக்கு. Then equity shareholder fund 8 lakh வந்து 4 lakh divided by 8 lakh we get 0.5 is to 1. This is a capital gaining ratio. Then come to the exercise number 7, calculation of debt equity ratio. So from the following balance sheet of James Limited as on 31st March 2019, calculate debt equity ratio, proprietary ratio, capital gaining ratio. The following information, find out the debt equity ratio, proprietary ratio, then capital gaining ratio. So long term solvency ratio at a time நம்ம என்ன பண்றோம்? Exercise number 7ல நம்ம calculate பண்ண போறோம். So look at the book students, see the question. Okay, the first one, formula is debt equity ratio. What are the formula of debt equity ratio? Long term debt divided by shareholder funds. Long term debit means debentures மட்டும் தான் இங்க கொடுத்திருக்காங்க rupees 3 lakhs. Then shareholder funds includes equity share capital plus preference share capital plus reserves and surplus. Equity share capital value 2,50,000 plus preference share capital 2 lakh. Then reserves and surplus rupees 1,50,000. Totally shareholder funds value rupees 6 lakh. Then what are the formula of debt equity ratio? Long term debits divided by shareholder funds. Long term debits of the value 3 lakh. Then divided by shareholder funds 6 lakh. So we get 0.5 is to 1. So in this ratio is known as debt equity ratio. Debt equity ratio 0.5 is to 1. Then second step, find out the proprietary ratio. Shareholders funds divided by total tangible asset is the proprietary ratio formula. Shareholder funds means equity share capital preference plus resource and surplus. Then total tangible assets value நமக்கு என்ன கொடுத்துருக்காங்கன்னா 12 lakhs கொடுத்துருக்காங்க ஆல்ரெடி அவங்களே. ஸோ ஃபார்முலா நம்ம இப்போ சப்ஸ்டியூட் பண்ண போகிறோம். ப்ராப்பர்ட்டி ரேஷியோ ஈக்குவல் டு ஷேர்ஹோல்டர் ஃபண்ட் 6 lakhம் டோட்டல் டேஞ்சபிள் அசட்ஸ் 12 lakh இருக்குது. ஸோ நமக்கு டிவைட் பண்ணிங்கன்னா லோயஸ்ட் நம்பர் வந்து நமக்கு நியூமரேட்டர் இருக்குது, ஹையஸ்ட் வேல்யூ டினாமினேட்டர் இருக்குது. அப்போ நமக்கு என்ன பண்ணணும், டிவைட் பண்ண முடியாத நம்ம 0 வச்சு தான் நம்ம பண்ண போகிறோம். ஸோ அதனால் நமக்கு ஆன்சர் பார்த்தீங்கன்னா நியூமரேட்டரில் 0.5ம் டினாமினேட்டரில் 1 இருக்குது. அப்போ ஸோ தட் ப்ராப்பர்ட்டி ரேஷியோ 0.5 is to 1. Then next one ratio, calculation of capital gearing ratio. Capital gearing ratio formula, fixed bearing fixed interest or fixed dividend divided by equity shareholders fund. So funds bearing fixed interest or dividend means preference share capital plus debentures plus long term borrowings. So fixed assets, that is a preference share capital 2 lakhs plus debentures 3 lakh, totally 5 lakhs is the funds bearing fixed interest or dividend value. Then equity shareholders funds means equity share capital plus resources surplus. Equity share capital 2,50,000 plus 1,50,000, totally 4 lakhs. In this value is known as equity shareholders funds value. So capital gaining ratio already நம்ம வந்து funds bearing fixed interest or dividend ஓட value 5 lakh divided by shareholders funds value 4 lakh. So we get 1.25 is to 1. This is a capital gearing ratio. So students, today we had learned about current ratio, quick ratio, long term solvency ratio, and that ratio is debt equity ratio, then proprietary ratio and capital gaining ratio. These are all the above topics are completed in this class. So chapter is not completed, remaining problems to be continued afternoon session. So understand the concept and thorough all the formulas. I will give few questions, write it in the assignment notebook. So if you have any doubt, please contact me. Thank you student.